Most homeowners are sitting on tens or even hundreds of thousands of dollars in equity, and they have no idea how to use it. Today, I'm going to show you exactly how to use your home equity to buy another house, step by step. Now, this could be a primary residence, it could be a rental, it could be a multifamily property. And no, this isn't some risky TikTok strategy. This is how people actually build wealth through real estate. Now, make sure you stick with me because I'm going to show you when this makes sense and when it absolutely does not. Now, many of you already know, but I've been in the real estate and mortgage business side for over 20 years, and I've helped hundreds of buyers and homeowners use strategies just like this responsibly. So let's take a minute here and break it down. I always like to start with a definition. So let's start with the definition of what home equity actually is. Home equity is the difference between what your home is worth and what you owe on it. A quick example is, let's just say your home value is $500,000. And let's say you have a mortgage of $300,000. That essentially means you have $200,000 of equity in that property. Now, realize that $200,000 of equity isn't cash just sitting in a bank where you can show up at the bank and just take it out with a card, but it is an asset that you can leverage. And the best part is that asset can grow over time in one of two ways. Either your home goes up in value, now your $500,000 home becomes, say, $600,000, or you pay your mortgage down every single month. Understand that every single month you make a mortgage payment, part of that mortgage payment goes towards the principal balance on that mortgage. So every single month you're making your mortgage payment, you're actually paying down that principal balance. But it's also important to understand in the first couple of years of a 30-year fixed mortgage, you're paying very little towards that principal balance. But over time, that principal starts to pick up, and the closer you get to paying off that mortgage, the more principal you're paying down every single month. That's it. Nothing complicated. So now that we understand what equity is, how do you actually access it? There are 4 ways that you can access your home equity. Each has pros as well as cons. The first is a home equity loan. This is a lump sum. It's a fixed payment. It's a second mortgage. An example would be that you borrow $500,000. You get all of that money at one time. You pay it back monthly just like a normal mortgage. It's very simple, it's very predictable, and over the last couple of years, it's probably been the most common because it's not as volatile as the next one we're going to talk about, which is a home equity line of credit, often referred to as a HELOC. Now, this works more like a credit card. You get approved for a limit up front, you only borrow what you need, and you only pay interest on what you use. Now, many times this is popular for those that already have a mortgage and they're trying to get money for a down payment. They're trying to get money for repairs. They're trying to get money for investment opportunities, or in some cases to pay off credit card. The big advantage to a home equity line is that it's flexible. So let's move on to the third option, which is a cash out refinance. This replaces your existing mortgage with a larger one in most cases because you're taking out more money. So let's say, for example, your current loan is $300,000. You get a new loan for $350,000. So in that case, $50,000 is coming to you at closing minus any sort of closing costs you have there, any sort of payments that you had. Maybe you were paying off credit cards or car loans or whatever. So the money between the new loan and your current loan is essentially the cash out part of that refinance. It's one loan, one new payment. The downside, though, is that you're refinancing your entire balance, which may or may not make sense depending on your current rate. Now, the last option you have in order to access that equity is just selling the house outright. You sell the property, you pay off the mortgage, and you keep the equity. Now, sometimes this is the cleanest move, sometimes it's not the right one. In fact, I tell almost every single seller that I meet with, if you can afford to keep this property and buy the new one, that's what I would do. And that's because you're never going to have regrets of owning real estate long term. In fact, some of the biggest regrets that I think all of us have that have owned real estate is actually selling those properties. We all wish we still had that property. We wish we could have kept it. So in my opinion, if you can afford to keep the property, you should probably try to do it. Now with that, let's move on and talk about why people are using equity and what they're using it on. The first one is to buy a new primary residence. A lot of people like the home that they live in, but they would love more space. Maybe they'd like a different location. A lot of people bought during the pandemic, and over time they've either outgrown that property, they made a rash decision and bought a property in an area they don't really like, so they'd like to keep it and take that equity and buy something else. And so essentially buying that new primary residence is the classic move. That's what most people do over time, buying that up-like property. And you can do that one of a couple of ways. We talked about the 4 different ways to access your equity. So depending on how much equity you have in there and whether or not it makes sense based on the new payment, you can decide whether or not it makes sense to keep that property or sell that home, use that equity for the next down payment, and move up in-house. It's very simple, it's very common, but what I'll tell you is that if you can afford to keep that property, you probably should. The second thing is buying an investment property. Now, I like this idea if it makes sense. Now, this is how a lot of people buy their first rental property, right? They use a home equity line or an equity loan like we talked about earlier for the down payment of that new property. They buy a rental or a small unit. They let the tenants help pay the debt. So going back to the example that we used earlier, your home is worth $500,000. You owe $300,000. Let's just say you take $100,000 out of your existing residence, right? Either in the form of an equity loan or an equity line. You use that $100,000 to buy another property in another area. Let's say, for example, you go out and you buy a $200,000 property. You put that $100,000 down. Now you're only financing $100,000. Chances are the rents coming in on that new investment property are higher than your mortgage on that property. So not only are you using that rental income to pay for your mortgage on that property, but you can use that profit and help offset that new mortgage that you had to get on your primary home. And over time, what you're getting is appreciation still on both properties. You're still paying down the principal on both properties. And that right there is how portfolios are built over time. Now, the last thing you might do is you might just pay off high interest debt, right? This one isn't flashy, but it can be powerful because credit card interest ranges anywhere between 25 to say 30% in some cases, and mortgage debt is closer to single digits. So in many cases, it makes sense to roll that high interest debt into low interest debt because overall, it can lower your total monthly payments. It can improve your cash flow. It can reduce financial stress. But this one only works if you don't run the cards back up, which unfortunately is what I see a lot of people do. Now, the fourth thing you can use this for is creating an emergency or an opportunity fund. And in my opinion, this is probably the most overlooked benefit. In fact, I wish I would have done exactly this during the pandemic when interest rates were in the high 2s, mid 2s, somewhere in that ballpark. I had a ton of equity in my property and my mortgage payment was already really, really low. I wish I would have known that interest rates were going to go up so quickly because I would have taken a huge lump sum out of my existing property at a very low cost and used that money to buy other real estate. But unfortunately, I didn't do that, and it's okay. But the key here to know is that having access to equity means you're prepared for things like major repairs. You can move quickly on opportunities. You're not forced into bad decisions. And just because you have access to it doesn't mean you have to use it. But like I said earlier, it's not all pros when it comes to this sort of thing. There are also risks involved that you absolutely need to understand because this is where people get in trouble. And the first one we want to talk about is over leveraging. If home values drop and you've pulled out too much equity, you can get stuck. Equity is not guaranteed. And this is essentially what got people in trouble back in 2008, right? They had their properties, they went up in value, and people were saying, hey, listen, you should refinance that property, take that equity out, and buy investment property, buy another property. And a lot of people did exactly that. But what happened is values went down everywhere. And unfortunately, a lot of those people that had those mortgages had short-term mortgages, not 30-year fixed like we have today. And what happened is those adjustable rates started adjusting and the payments started going up and those properties no longer made sense to keep. So while we're not anything like we were back then, it's important to understand that you don't want to over leverage yourself because if you do, selling a property, refinancing a property can be very, very difficult, if not completely impossible. The second thing we need to talk about is cash flow and income changes. You still have to make the payment. If your income drops, you have a job change, life happens, that new debt doesn't disappear. Always stress test your numbers up front. You need to know exactly what you can afford if things go sideways. That's why you need to have a real life budget. On top of factoring in replacement cost on investment property. If you're planning on buying an investment property or buying a new property and keeping yours as an investment, you need to factor in replacement costs, things for, roof, plumbing, repairs. Things always happen, and you need to make sure you have the money set aside in order to take care of those repairs. Now, the reason a lot of you clicked on this video is because I talked about how to use your equity to buy another property with that equity. So let's tie this all together. Let's say that your current current home value is, say, $500,000. Again, we're going to use that mortgage balance of $300,000, which basically means that you have $200,000 of equity in that property. Now, let's say you want to keep the home that you currently have and rent it out. You want to buy a new property for $500,000 and you want that to be your primary residence. So let's say, for example, on that property, you need 20% down payment in order to make it make sense on that new property. So essentially you're financing $400,000, which basically means you need $100,000. Well, the strategy in this case would either be to take a $100,000 equity loan or some sort of home equity line from your existing primary home. Now the payment on that is going to probably run somewhere between $700 to $800, guessing just a little bit. Now understand, the rental income on your current home when you go to rent it out is going to offset that old mortgage and that new equity loan. But here's the key: by leveraging that current property, you're able to keep that property, you're able to buy the new home, and over time you're able to build equity in two properties versus just one. Now this is very, very real. It's very common, and when the numbers work, it's a fantastic idea. But here's the thing: the numbers never lie. The very first place you need to start in a process like this is talking to a professional mortgage lender and talk about refinancing your current residence, whether it's either the whole entire balance or taking out an equity loan or an equity line, just to figure out what that new payment is going to be. And then you need to talk to a professional real estate agent in your market to figure out what that property is going to rent for. How much rent's it going to bring in versus how much your new mortgage payment's going to be with property taxes, insurance, HOA fees, everything. And then you can see if it makes sense. Are you in the red? Are you in the black? Are you breaking even? And what I would say is there's no right or wrong answer here. In some cases, maybe you're losing money, but you're able to buy your dream property with the equity you're pulling out of that property, so you're okay losing a little bit of money here so that you can buy that property. Or maybe you have a super low interest rate on your current home, and that rent, even with the new loan that you're taking out, is going to be higher than what you currently owe on that property. So in that case, now you have more income on your current home that you can use to offset the mortgage on the new home that you're buying. But either way, that call with that lender and that realtor should open your eyes. It should make it very, very clear whether or not it makes sense. So before you just go put your home on the market or call a lender and start taking out money without actually knowing what the repercussions are or whether it actually makes sense, that is definitely the first step. Now, if you're watching this, you're not sure where to start, there's a link in the description of the video where you can speak directly with my team to talk about the lending side and directly with me to talk about the real estate side. Understand that home equity is one of the most powerful tools that homeowners have. But like any tool, it can help you build wealth or it can create problems if it's used wrong. The key, like we said earlier, is understanding your options, running the numbers, making decisions based on your life, not hype. So if you're thinking about using your home equity and want to know what actually makes sense for your situation, reach out to me and my team using that link in the description of the video. We'll walk you through the numbers, we'll pressure test the strategy, and help you decide if it's the right move. And lastly, if this video helped you, make sure you hit the like button, subscribe to the channel. We'll see you on the next one.